No, we're good. We're good. We're going on YouTube. I think my computer got scared of me when I used my Queen tone. There we go. It's coming. Give me a second. There we go. Everyone will have a little pop in to say, oh, no, we're good. We're good. We're going. Wait, there we go. Mute, unmute. Cool. Awesome. Cool. We are in. Hello everyone, Zibuni Salimova here from Mike Piro Mortgages in sunny Waikanae. Tonight, I am joined by Shane Storey, Managing Director at Storey and Associates in Palmerston North. Good day, Shane.
Hello.
Thank you so much for giving up your time and joining me on this adventure. This is one of many webinars, I hope, that we'll do together. I know usually you're used to seminars, standing up with lots of people, but tonight I'm bringing you a new experience. We've got heaps of people online tonight from all sorts of places in New Zealand, it seems. And let's share your knowledge. Take it away, Shane. Tell us who you are, what you do, and what you're gonna tell us tonight.
All right, hi everyone. It's as Zeb has said, I'm Shane Storey from Palmerston North. I've got an accounting practice here where we have a large majority of our clients are property investors, and I have a portfolio of property myself. So I'm not just talking theoretical, I'm also talking from a practical perspective. Last year, the Manawatu Property Investors Association asked me to comment on how the new interest limitation rules work. So I put a presentation together, which is what I'm going to show you guys tonight, to try and explain in a practical terms how these rules work. This is very general, and between different clients, different scenarios, one answer may not be the right one for the next client. So this is a general terms. If you want to know how it applies, go back to your own accountant or give me a call and we can walk through how it would apply to you. But okay, let's work our way through this.
Awesome. Thank you, Shane. So you guys heard it all. It's a general advice, only general information, sorry, not for personal advice. So please don't take our words tonight as a message to you to go ahead and do something about it. So if you want something personalized, come back to Shane or go and talk to your accountant. Awesome. Go, Shane.
Okay, interest limitation rules. The more cynical of us would call it Labor's interest surcharge. This is very much an envy tax. They can't get capital gains through, so they're going to try and hit us with interest charges, taxes on interest. All right, so this is a general overview. It's of issues you need to be aware of. You need to obtain independent advice, as I said before, on how it could affect you personally. DRP, Disallowed Residential Property. This is an IRD term. So what does it all cover? Any residential property in New Zealand, which is a permanent place of abode, any bare land that could be used for residential. There are exemptions, social emergency housing, but this is contracted out to agencies that provide these services, not as if you are doing it as an individual. Business premises, farmland, hospital, hospice or nursing home, hotel, motel or camping grounds, rest home retirement villages. So these are exempt. Student accommodation, but student accommodation, I mean, this is the area I have my property in, but you have to be leasing it to the university on a long-term basis. This is not just casual students on a year-to-year basis. Employee job related, boarding establishment, but it has to be 10 or more rooms. Your main home, flatmates, boarders, home office. Maryland is exempt. And overseas rentals. So your overseas rentals are caught by the bright line test, but they're not caught by the interest deductibility rules. New builds. New builds have their own set of rules. All right, so the set of rules for new builds, the key is a code of compliance. And if the code of compliance has been issued on or after the 27th of March 2020, there's another set of rules, but I'll just come back to that in a moment. In this presentation, I'm going to be talking about new builds, which is the 27th of March 2020. It's existing property, which is 27th of March 2021, and another one called Rollover Relief, which is 1st of April 2022. So it's quite a minefield in there, and you can easily set off a landmine and get yourself caught. All right, so for new builds, code of compliance on or practical completion. And so that's the process from buying the land to getting council permission to build on it, all the way through to putting a tenant in. If IRD suspect that you are stalling, they will remove that ability to claim interest on it. So you need to be showing that you are constantly trying to get this project together. Conversions. When you convert a commercial, motel, hotel to residential rental. New house on an existing residential section. Now, you buy a property and you rent the house on the front. That's the old rules. If you put the back section and put a new house onto it, then the back section in the new house can be claimed 100%. If you move the front house to the back and then put on a new house on the front, you can claim interest on them both. Now, at the moment, I'm getting an opinion on if you have a house and you lift it straight up and put another flat in underneath it, would that both flats now be considered new builds? But we haven't heard back on that one yet. And I may actually be doing that on my own properties. Relocates leaky homes, but you have to have 75% reclad. If you move a load-bearing wall in a house and convert it from, say, 2 bedrooms to 3 bedrooms or something like that, and you get a code of compliance, that's not considered a new build. It has to be a completely separate unit. And by a separate unit is one where you have its own kitchen, its own laundry, its own bathroom. So a sleep out's not included. Earthquake building, prone buildings upgrades. So loans to do any of this can be claimed. So we can claim 100% deductibility for the next 20 years from the time of code of compliance is issued. So it might take 18 months to buy the section, get the council permission, get it built, get it ready for the tenants to move in. All that time you can claim 100%, but the meter starts ticking once the code of compliance has been issued, and then you have it for 20 years. Not limited to one owner, so you can sell it after 3 years. The new owner has 17 years, continue to claim on the 100% interest. They don't apply to land dealers, developers, builders, undertaking or subdivision to create new builds. These are 100% up to the point of code of compliance, then the 20-year rule. They have their own set of rules. Otherwise, all other New Zealand residential property is caught. How do they apply? Right, property acquired, and this is the second important date. Property acquired before the 27th of March 2021. From the 1st of April 2020 to the 31st of March 21, 100%. The next year, from April 21 to March 22, is 100% for the first 6 months. And then the second 6 months, we can only claim 75%. In the financial year that we are actually doing now, which is to the 31st of March 23, it's 75%. But today, which is the 19th of June, we are actually in the March 24 tax year. So if you've got rental properties, you can only claim 50% of the interest now. This is when it's going to start biting. I'll show you the real cost involved. From the March 25 tax year, year ending 31st of March 25, we can only claim a quarter, 25%. And then from the 1st of April 25 onwards, you cannot claim any interest on the mortgage, period. All right, property acquired on or after the 27th of March 21. You could claim 100% for the first 6 months and then nothing from then onwards. This includes extended loans, i.e. for alterations, offshore loans for New Zealand properties, unless they've been converted to New Zealand dollars. That's another story on its own. All right, just how brutal are these rules? I'll give you guys a moment to work through this. You buy a property for $650,000, it's renting for $660 a week. Management fees, rates, insurance, repairs and maintenance. So you have a gross profit of about $25,000 from a $34,000 rent. In normal circumstances, 5% mortgage, for instance, $32,000, the property's making a $7,000 loss. That's fairly typical of a lot of stuff I see come across my desk. When you're on about 33% tax rate, you would get a $2,300 refund. The net cash flow was $4,800. Now, I know someone will talk about ring fencing losses and so on, but in the long term, this is basically what it look like. Right, if we can't claim the interest, and we look here, here we go. So the gross profit is 25. We now can't claim the 32,000 in 3 or 4 years' time, interest on that loan. Although you've got a loss, cash flow loss of 7,300, you're going to have to pay tax of 8,300 on this figure. You don't get a refund. So your net cash flow position is you're losing 15,000, about $300 a week. You'll be paying tax even though the property is making a loss. If you acquired it today, purchase price, same property. $650,000, you've got a $15,000 loss. If you pay $340,000 for it, then you'll only have a $95,000 loss. If there's a 47% fall in value, the property will break even. That's the sort of forces going on in the market where people who have to get out aren't going to be able to sell to other property investors unless they're going to discount the property heavily. The other option is lift the rent. So if you lift the rent from 660 to 1,150 a week rent, the property will go from a $16,000 loss to a $99 loss. That's a 75% increase in rents. So the economic effect is how prices have to come down and rents have to go up. It's pretty stark. If you acquired the property prior to 27th of March 21, again, this is how I got my numbers. So work your way. Any interest that is related to residential rentals that is unclaimable can be offset against the bright line test. So if we go back in here and you see how these losses are here, we go back several weeks. So this interest here, this 32,000 that we can't claim. You can, what we are doing is we're setting this aside on all returns on the file. And if you sell the property after 5 years and there's $150,000 worth of losses here, we can offset that against any bright line test profits. So keep that in mind too. Some back down. Revolving credits and refinancing. What was the balance of your revolving credit as at the 26th of March 21? This is the maximum you can go back up to. So if you've got a $100,000 facility and we're sitting on 80,000 on the 26th of March, you cannot go higher than 80,000. Anything over 80,000, and you can't claim the interest on it. You can pay it down or redraw it if it's for rental purposes, but you can't go over that 80,000. You can still claim it for anything under 80,000, the interest on it. You've got the sliding scale. Rollover relief. As from the 1st of April 22, and this has caught a few people out too. If you sell the property in relationship property, it's based on the original purchase price. Death and transfers to trusts, LTCs, partnerships, and individuals. So if you've got relationship property and it's transferred to one of the original purchasers, then if it's in the property settlement agreement, it's as if that person bought it in the first place either a couple of years ago or even 20 years ago. Then the rules apply as if it had been done then. Same with death. If it's a house that's to be divided to 5 people, and after a couple of years, one person decides to buy the other 4 out. The other 4 are not affected by bright line test. The 5th person who buys the others out, 1/5 is not affected by bright line, but they can only claim the sliding scale interest on 1/5. The other 4/5 they can't. It's considered a new purchase. You can transfer to a trust, etc., but that trust needs to be more or less the same as yourselves, the same settlers, trustees, beneficiaries. Right, how to limit the damage. There is some ways that you can limit it to a point. Rule 1, it's not what it's secured against, but it's what it's used for. It's the rule for claiming interest on loans. You can borrow against your grandmother's Visa card and claim 100% interest if you use it for a new build, pay off a shareholder current account in a business, company or trust, business motor vehicle, property trading, dealing. You can claim all the interest on these. And even though it's in your grandmother's name, if you can show that it's been used for any of these points, then you can claim the interest on it. So if we take that a step further, rule number 2, if you park your car in my car park, does that mean it belongs to me? Well, no. And my daughter took this to the ultimate conclusion. She came to me one day and she said, could she park her $10,000 that she had saved in term deposit into my revolving credit? Which is not a bad idea, actually. Because if I was at the time paying 5% to the bank, and she could only get 1.5%, and if she put it on term deposit for 6, 9, 12 months, by parking it in my revolving credit, it's on call. Versus she had to fix it for 12 months. There is one side of that too. She gave me a piece of paper I had to sign, and it said that didn't matter how big a row we had, she could still give me 24 hours and could withdraw the money. And I had to pay her the interest. If you got a revolving credit that was used to purchase what is now DRP, disallowed residential property, the allowable interest is falling from 100% down to 0%. So if you've got a tax bill coming up, GST, income tax from bright line test, for instance, provisional tax, and you pay $50,000, you have a $50,000 bill to pay in 10 months' time. Well, you can park that money in the revolving credit. And if it's $50,000 limits, it's sitting on 0 today. And you're saving on the interest. In 10 months' time, you draw down the $50,000 to pay the tax. The balance on the account is back to $50,000, and the bank is charging you 5% interest. The question I have is, what has that $50,000 now been used for? It's not for the DRP, disallowed rental property. It's now being used as a business loan to pay off taxes. So now you can claim 100% on that revolving credit. If you have a company that's not into rental properties, just a normal trading company, you have a shareholder current account of say 300,000. The company owes you 300,000. If you ask the company to pay out and it raises the money by taking a mortgage on one of your rentals, and you use that money to pay down another mortgage on the DRP, you've raised a business loan to pay off an interest limitation rule loan. So now you can claim the interest on that 300,000. Remember, it's not what it was secured against, but what it was used for. So there are some limited ways of getting around these rules where you can claim only limited amounts of no interest at all, which is about $5,000 in taxes. It's worthwhile chasing. ASB Westpac wouldn't do it without a transfer of title, but BNZ said they would. They're still getting their heads around it, I think. Any questions?
Wow, that was mind-blowing, Shane. I think let's give everyone a second to sink in. But I mean, even as an active investor myself, I believe I've learned something tonight, and certain things that could be done to help me not to pay such a huge, large tax bill that will be waiting for me shortly, I believe. Awesome. So guys, any questions at all, please feel free to put them in a chat box. If you've missed something, if something was unclear, we are here to answer your questions for the next 15 to 20 minutes. So please fire them away. We've tried to compact as much information in here as possible to help you guys out. I know some of you here already have a property, some of you are looking to become an investor, and some of you may have a portfolio of properties. So any of this could be useful. Just trying to think if I should. Everyone's very quiet, Shane. Pondering life and taxes. I'm impressed. Nothing's happening. This is the quietest I've ever had.
Can I ask a question?
Okay, you want to ask in person? Sure, go for it.
So I have a rental property, and now I'm gonna do the end of the year, the financial. So I understand if I still, so I need, for example, if it's turned out that I still need to pay to the government.
When did you buy the property?
So I bought it in 6th of April, 22nd.
2022.
Or 22. Was it a new property or was it an existing property?
Existence property.
Okay. If we go back through the rules, we need to go back here. Right, so if you bought the property before the 27th of March, then these are the percentages of the mortgage we can claim. But you've bought an existing property after the 27th of March 21, 6th of April 22, we cannot claim any of the interest as an expense.
Ah.
And you've got, you probably thought you had this scenario where $34,000 worth of rent minus expenses, minus interest costs, you've got a $7,000 loss. And although you won't get this refund, that loss will accumulate over the years until you still start showing a profit. But the difficulty is you can't claim any interest Where's the I'm not looking for? You have this scenario. This 32,000 is non-claimable. So you're actually going to be paying tax on top of the loss that you've got. You're going to be paying an $8,000 tax bill. So you're running about a 15, in this scenario I've got on the screen, you're running at about a $15,000 loss. How much did you pay for the property?
475.
What kind of rent are you getting?
So at the moment it's 380.
380.
So, Daniel, you need to go and speak to Shane personally. Because remember, this is not a personal advice tonight. We're just doing general advice only.
So you've got to do a tax return for the year ended 31st of March 23.
Yeah.
So you've either got an accountant or you want to give me a call and we can have a chat. But yeah, unfortunately, I'm guessing you've got a tax bill, even if the property is running at a loss.
Yeah, okay.
Probably not what you wanted to hear.
No, I roughly know that because yeah, I heard about the rules that they have changed, and I was thinking, oh, I'm probably gonna be a little bit in loss, not too much.
Well, if you're in a loss, then you'd have no tax to pay. But if you take away the interest that you're paying, and that will probably create a profit, you're going to have a tax bill.
Oh. Thank you,
Okay.
Daniel.
Thanks.
I've got a next question for you, Shane. Oliver is asking, this method relies on you having some cash available put in a revolving credit mortgage, right?
Yes. Now, in the scenario I gave you, for instance, if you've got $20,000 tax bill coming up for whatever reason, instead of putting it into a savings account, if you park it in the revolving credit and then draw it down again, that 20,000 proportion is now been changed from a rental loan to a business loan. And you can claim the interest on it. So you may have a situation where half the revolving credit is rental and the other half is business. And your accountant will bless your cotton socks trying to work that one out.
That was awesome.
Can you guys hear me?
Yes,
Yep.
we can hear you, Eugene. Go.
So thanks for answering my question there, Shane. It would be nice to have some cash sitting around so I could do this. But so what you're saying, are you saying potentially like my business could go and take out a loan, and then I could use it to put in a revolving credit mortgage, and then that would sort of offset any tax I'd have to pay?
Well, it's not just a revolving credit. Revolving credit is handy because in that instance what I'm talking about, when you've got taxes, you've got your bank account jumping in value, jumping in loan value on a day-to-day basis. But if the second example I showed is if you've got a large shareholder current account in your company, you put a lot of money into the company and you're waiting for it to come back. So the company has a loan to you. You can swap that loan from a loan to you to a loan to the bank.
So can you essentially like value your company at a certain
No,
you can't, like that
No.
that cash has to be there, it has to exist.
That's right. Well, that debt owed to you from the company to you needs to be owed.
So what if your company doesn't have any debt and it's just kind of like your company has a lot of assets?
Then you're getting into the zone of dividends paid out, shareholder salaries paid out. It can be created, but now we're getting into quite a complex area.
Yeah.
And that's one, go back to your accountant and give him the example I've just given, he'll know what I'm talking about.
He or
And
she.
he'll be able to,
And if
and
he
he'll
doesn't,
know. Yeah, if he doesn't, then you need to talk to me. He'll know what I'm talking about. And he may actually say, no, in your circumstances, it can't be done. Or he might go, well, if we do this and this, we might be able to do it.
Oh yeah, that's really interesting.
Now, I've got a client who had a $50,000 GST bill on a 6-monthly cycle. And he built up the money for that $50,000 to pay by parking it in his rental revolving credit.
Okay.
And then he drew it back down again to pay for the GST. And that
So
became
he basically, so his business was making this money, and he put the money into his revolving credit for his rental.
he parked it there and then drew it down.
Yep.
And now the reason for that drawdown was for business purposes, not rental. And he converted that rental loan into a business loan, and he can now claim 100%.
Oh, yeah, that's really good. It sounds like these people have got really successful businesses to be able to put that amount of money in there.
No, well, he had to pay a massive big GST bill.
Yeah. Oh, yeah. Yeah. So he's just good with that. Oh, yeah.
Rearranging the deck chairs on the Titanic.
Yeah.
But again, if you show your circumstances to your accountant and give him this idea, if they've got their head screwed on, they'll know what I'm talking about, and they'll look at your circumstances and say yes or no.
Okay.
And this is how you can do it.
But yeah, it would have to be for the next tax year. There's nothing,
But I mean, you can do that with provisional tax. You can do it with income tax.
Yeah.
Oh,
Would you? Oh, sorry. I'll open it up for someone else to ask a question.
no, Ollie, that's good. Just make sure you don't ask any personal questions, because we don't want to get people to think we're providing any personal advice tonight. Everything is very generic in purpose. And, and if you do want to take this further, you can always contact Shane. As you can see, his logo is on the screen, Storey and Associates. They are in Palmerston North, not that far from us. And, he's available via phone calls and emails and all sorts. So I would highly recommend reaching out to him. Very knowledgeable man.
Yeah, sounds like he's definitely thinking outside the box.
Exactly.
Shane, would you mind touching on the different rules that existed for builders and developers?
Well, builders and developers are considered businesses. They're not investments. And if they're businesses, they're no different than any other business buying and selling a product.
Okay.
So they're not going to hold that house for 20 years and rent it as an investment. They're going to buy it, develop it, sell it, and turn it over. So in that instance, they're considered a business, so they can claim all the interest.
So what if the rental property wasn't set up as an asset business?
If they've built it as an investment, there's another set of rules. And there's the Bright Line rules, and then there's the old rules before Bright Line came in.
Yeah.
And if you want another evening, I can go through those rules for you. And there's a whole bunch of tainting issues involved in there as well. So you don't want to be related to a builder, because you may end up being tainted.
That's not what I wanted to hear.
Nope. All right, Ollie, I'm going to move on to the next one, if that's all right.
Of course.
And if you guys do have any ideas of what you want us to cover in our next series of this, because we will try to do this once a month with Shane for the next few months, do reach out to me. If there's something in particular you wish to cover off, let me know, and I'll ask Shane to prepare it for us. I'm just dropping off his ideas and his contact details in a chat box as well. So you guys got his details to contact. There is email address, there is website, and there is phone number for Shane. Cool bananas. Shane, I've got one more question here for you. What do you think when Nationals win in October? Is there a chance that the treatment of interest deductibility will change for the future years?
Rule number one with politicians. How do you know a politician is lying?
I was about to say, never believe them.
Their lips are moving. Chris Bishop has said on several occasions that they will reverse it. They won't reverse, but the question is when. And I think everyone's still going to get stung with this 50% that we're in now. I doubt he will backdate it to the 1st of April 23. I think the trigger date will be the 1st of April 24. So we're going to be stung with this 50% non-deductibility this year. ACT have said that they will throw it out straight away. And they have said that they will throw out ring fencing and bright line back to 2 years. I think National's actually said they'll take bright line back to 2 years as well. So the National has said that they'll remove it. The question is when.
Exactly. That was a good one. Awesome.
Chris Hipkins, if he really wants to get back into power, he will reverse this, because even those who are staunch Labour supporters are now going to be hit in the pocket so hard they have to vote National Act.
Yeah.
So if Chris has got any, he wants to keep in power, he's going to have to drop it.
It is hurting a lot of people, and the interest rates rising is not helping, because
very much so.
Yeah, they're paying more and more in interest. They're not able to offset it.
And it hasn't really bitten yet.
Fully.
It's this time next year people are going to start seeing those tax bills.
Yeah, 100%. Literally 100%, guys. Unless you do something about what we've covered off in this presentation. Paul, I'm just trying to see. We do have another probably 5 to 10 minutes for one more question. If anyone wants to jump in, you can either start talking or you can put it into the chat bar. And as I said, if you've got any ideas of what you want us to cover off, drop it in as well. Shane, what other topics have you done in the past that we could propose for our next one?
All right. We've got some other boring accounting stuff. What can you actually claim on your rental properties? The bright line test rules. And I've got a different one altogether, which is on demographics and how different age groups can affect different parts of the housing market. Students, first home buyers, second home buyers, empty nesters, as in grandma selling the home moving into a 2-bedroom flat. And some research that we've done, we connected that with the birth rates. So today's student accommodation demand is dictated to by birth rates 21 years ago.
Whoa.
And it's been giving some almost spooky predictions as to how accurate it is. So that's another topic we can go through.
Okay, that makes sense.
And there's another one on inflation in oil and how oil affects inflation. And you can foresee where inflation is going by looking at where oil prices are.
Nice.
Would you be able to do a revolving credit a session on that, just to sort of give some examples of how,
like case study?
Yeah, maybe.
Yeah. Look, if you could send through an example or several examples, then I can walk through what I would recommend if it were my portfolio.
Would you like me to put something forward now, or?
Well, not tonight, but send me through an email and give me 3 or 4 scenarios as to how we work revolving credits.
Yeah. Okay.
Oh.
Thanks for that, man.
Awesome. Thank you, Ollie. And make sure you come to the next one as well, so you can hear it.
Yeah, I'll definitely be taking part.
Yeah, and tell your friends that are not builders.
Yeah.
Awesome. Well, if we don't have any more questions, guys, I just want to wrap it up here. Thank you so much for coming along tonight. I hope you've learned something new today, and I really hope this was useful, and I will try to save it on YouTube. Hopefully YouTube is not going to bring this down like they did my video with Santa. It was really interesting. I don't know why my video with Santa got taken down. But anyways, we'll leave it on YouTube. Hopefully you can share with your friends as well. And we'll go from there. I've dropped change details in the chat box. Try to save it before we close this window. And thank you everyone for coming. And Shane, thank you so much for taking out a Monday night to do this. I really appreciate your time.
Is this what you were after?
Thank you. No, this is perfect. We've had about 15 people in Zoom. We had about 5 people watching live on YouTube. And I know we had several watching on Facebook as well. So not a bad turnout. And we didn't have to put out tea and coffee for anyone. How good is that? That's
all right.
Awesome. Thank you so much, everyone. Have a fantastic night. Thank you, Shane.